Hello, my name is Brenton Harrison. We're back today with another installment in our series on financial trends you see on social media, whether it's Instagram, Twitter, TikTok, Facebook. We're going one by one through these trends. And today we're talking about building credit for your kids. We see people talking about putting credit cards and utility bills in their kids' name and the aims of building credit for them that will benefit in their later lives. And we're going to get into that. We're going to get into some things that might be lacking in context, but also the portions of it that are worth implementing for the betterment of your child's finances. Let's get started. We're going to use this tweet as the jumping off point for our video today. And it's the only one we're going to cover, but I think it's one that's really instructive as to some tips and tools and what's real and what's fake about building a child's credit. Here's an example of an idea that also holds a sliver of truth that's lacking in context. I also admire this idea because if you're a person who's worked hard to build and maintain your credit, or a person who's struggled to build and maintain your credit, of course, you would want to put your child in a position where it's something that they don't have to deal with as they grow up. Well-meaning parents always want their kids to have it better off than they did financially. And of course, it would benefit an 18-year-old to start off strong in terms of their credit, as opposed to them trying to build from scratch at that age. But can you get a credit card in your child's name? And if so, will it actually build their credit? And if so, will their credit be so strong that that's all they need to buy a house at 18 years old? The answer is yes and no. This is really a half truth. Let's start with the difference between your child having a credit card and having access to a credit card. When you apply for a credit card, that credit card issuer uses a combination of your income, your credit score, the dependability of that income to determine whether or not you'll be approved. It's based off your credit and your credit and income alone. But after you've been approved, many cards give you the option of adding what's called an authorized user. When you add an authorized user, that user will be the beneficiary, good or bad, of however you handle that card financially. If you make payments on time, it will reflect positively on that authorized user's credit report, even though you made the payment. If you keep your credit utilization low, it will reflect positively on their credit as well. Their credit score becomes a reflection of how you use your credit if they're your authorized user. And unfortunately, if you have bad credit habits, that will reflect negatively on their report just like yours. So if you've been struggling to manage your own credit cards well, it's not as simple as just getting your child a card and giving them strong credit. They are piggybacking on whatever credit habits you're exhibiting in your financial life. Now, yes, some credit card issuers will allow a minor under the age of 18 to be an authorized user. But the caveat is that not all credit card issuers do. Even some cards that allow minors to be authorized users might have a minimum age of 13 or 16 years old. So you can't sign up a newborn baby as an authorized user and think that they're going to have 18 years of positive credit history. If we're going to be optimistic, though, then conceptually, adding your child as an authorized user, if you manage your debt well, can give them the ability to have a strong credit score at the age of 18 based on your positive habits. But let's go to the part that's the half truth, and that is their ability to purchase a home by themselves. Because unfortunately, a strong credit score isn't all that's required to purchase a home. There's another important element that has absolutely nothing to do with your credit score, and it's called your debt to income ratio. When you apply for a home, the two most important factors are your credit score and your debt to income ratio. And those two things are relevant to different portions of your home loan. Your credit score determines the interest rate you receive on that loan. They're looking at your habits and they're saying the better your credit score, the lower the interest rate we're going to give you. We're going to make it cost less to purchase this home because we are more bullish on the fact that you'll pay us back. So the credit score determines the interest rate. Your debt to income ratio is an expression of how much of your monthly income is swallowed up by your monthly debt payments. They're trying to see how leveraged you are financially. And your debt to income ratio is what actually determines how much loan you'll receive. So the credit score determines if you get 4% on your home loan or 3%. Your debt to income ratio determines whether you can borrow $100,000 or borrow $200,000. Your lender wants to make sure you can always pay them back. And someone who has too many debts coming into the application process is not going to be in a position where they can get a home. Or someone who doesn't have enough income coming into the process won't be able to get a home. This wrinkle is what makes it unlikely for an 18-year-old, even one with a strong credit score, to be in a position where they can buy their home on their own, because they may not have the income to justify getting a home, even if they have an 850 credit score. What they would likely need is someone to co-sign on that home loan, which is probably the same parent that put them in a position to have a strong credit score. Now, if you can do that, that is amazing. That's wealth building. That's generational wealth. But it's very, very different from your child getting a home on their own. And unfortunately, when you tell someone that without the context, they believe that their child can get a home on their own. And it strips them of the ability to understand that they have to build together, so that when we're going to get that generational wealth, we're getting it from both generations, not just the 18-year-old. Also important is, if you are in that position and you co-sign for that loan, you are taking on an equal responsibility for that debt. So if you put your 18-year-old in that home and they miss a payment, now that reflects on your credit score. Your home can be foreclosed. You can have something on your credit report that's based off of your child's credit habits. So at some point in the other, one hand is feeding the other. You have to make sure that all these things work together. And when done positively, they can lead to some amazing things. But every single part of the equation has to be in order to make sure that you could take advantage of this opportunity. My name is Brenton Harrison. Hope you're enjoying this series. And next week, we cover the last installment where we get into something called Forex trading, what it means, how it works, and how realistic it is that it could be something that can replace your 9-to-5 job. See you then.